G'day guys, James here from the Atlas Wealth Group. Just wanted to thank you all for tuning in each episode. If you like the podcast, give us a like, rating and share with your friends, just so we can educate and inform more Australians. Be well and see you on the next episode. G'day expats, ladies and gentlemen. Thanks for joining us today on another episode. As always, joined with my co-host Jeremy, who's fresh from the webinar last night. How you going, Jeremy?
Good, thanks, James. Thanks for having us. Excited to talk about, we've got some inflation numbers that have come through today.
That's right, mate. The March quarter readout, it's very fresh, only a couple of hours old, or I should say just over an hour and a half old. And we want to deep dive into this a little bit because we know that in the last minutes from the RBA last month, or this month, sorry, they said that they're going to be keeping a close eye on the quarterly readout, what that means for interest rate decisions going forward. And all in all, I would say some good news regarding, the figures. What were your thoughts, initial thoughts?
So it came in on year on year for 12 months, for March, of course, it came in at 7%. And so as we seen, the market was anticipating about 6.9%. So in line with the overall expectations.
Yeah.
I think it's looking like, particularly now that we're getting those monthly readouts, so potentially we're starting to trend down from that peak back in December last year, which I think it peaked at 8% on a monthly, then 7.8% for the quarter. So it's probably a little bit too early to call, but
Yeah.
it does look like we're starting to trend back down to some normal levels.
That's right. And I think a careful takeaway is that it's the softest sort of figure or readout that we've been given in about a year. So it does mean that ideally that inflation figure or CPI has peaked and we're starting to trend downwards, as you said. What do you think it means for next week or next week's rate decision, I should say?
Yeah, I mean, if we look at the last minutes, they did, and as they have been recently, put a lot of emphasis on the savings ratio of the household. So I think, yes, this will be a key bit of data that they use as part of their decision. But, and maybe this is even in conjunction with the review that's just gone on with the RBA board and the findings that got released, but maybe they're sort of taking not the sole focus just be on the inflation readout, but looking at some of those other indicators to see how healthy all the Australian households are. So I think they'll also be keeping paying a fair bit of attention to how that looks like in terms of savings ratio and some of those financial stress indicators that they're looking at.
Well, I mean, it's a good point you make about savings ratios because I know that's something you drilled down on last night in the webinar where you were talking about how I think you mentioned the savings ratio was negative now, which means people are starting to eat into their buffers. Is that correct?
So some of their disposable income on aggregate is presenting as heading into that negative territory. So yeah, households, I mean, on aggregates, not every household, but some are starting to have a negative monthly cash flow and starting to draw down on that savings buffer that they accumulated during that COVID period.
That's right. And I guess that's just probably a sign of people having more money in their offset accounts and then now they're starting to use that. April is an important month because we know that a lot of those fixed rates are now starting to kick out. On a previous episode, we talked about the concept of this fixed rate mortgage cliff, and we know we're starting to move out and a large cohort, 800,000, they're starting to kick out from the 2.5%, 2% to 5.5%, 6%. I think the big ones were sort of June, July. That's when a large percentage were kicking out. With this kind of readout, I know you can't comment on interest rates or make predictions, but personally, I think this is obviously really good news, even though it was technically above the expectations. I mean, expectation was 6.9%. This is 7%. Trim mean looked a lot better, though. I think it does mean that the RBA will probably pause, I reckon, on next week's decision because they've got a bit of time now that inflation has sort of shown that hard data that it's slowing down. Do you think from this CPI readout, do you think any of the major banks take this into account and what they might do as well?
I think they will. The banks would be led by obviously firstly what the RBA does with their decision, but they look sort of internally around their own cost of funding. I've noticed in the last few weeks just on the variable front,
Yep.
the banks are starting to be providing less of a discount for new lending.
Yep.
So I think banks are aware of the fact that the cost of funding on their back book is starting to eat into their margins as well.
Yep. Yep. And I mean, the cash rate in Australia, as a reminder for everyone listening, it's 3.6%. I think when we looked at that ASX futures tracker, which is really interesting, I think it was predicting it peaking around, I want to say 3.7, 3.8%. I'm not sure if it's changed now. When was the last time you had a look at that, Jeremy, that ASX futures tracker?
Just the other week, so it showed that it was, we're at that peak, and in the next sort of 12 months, it's anticipated around that 3.2%.
Yep. Yeah, I mean, it's a good sign. I mean, ideally, it means within 12 months, we're starting to track down towards from 3.6 down to 3.35%. But I think we're there. I really do think that we might not get one more. I really think there'd have to be something drastic that would happen in the coming 3 or 4 months to really make the RBA, keep going. When you've got inflation starting to show that key theme, it's coming down. Be very interesting to see what the RBA does. I personally think there's going to be another pause. It's also a case where it's coming up to the budget. I think the RBA tries to tread a little bit carefully around when the budget is released as well. Don't you agree?
Correct. And also, if you look at some of the categories of this recent inflation readout, so some of those discretionary items like your clothing, footwear, even furnishings for household goods, it's come back in terms of the quarterly change. So if you dig a little bit deeper and look at what's driving that, so still persistently things like electricity for households, that's well above the overall 7% increase.
Yeah.
So I think the RBA will realise that their monetary policy alone won't do a lot to change the inflation figure coming out of those subcategories.
That's right. Yep, agree. And I mean, when you look at food as well, I saw that there was lower food inflation for that period as well, which I really wonder what's actually causing that. Because, I mean, we've had a lot of natural disasters which usually increase the cost of just food in general, especially around the logistics side. So I wonder why that's come off a little bit. I wouldn't assume that we're consuming less food. So I'm just, that's a bit bizarre, that one. But I agree, some of the areas that have consistent high inflation, there's not much that the RBA can really do by adding another interest rate, 0.25%. Nothing's really going to change those sort of figures. We all need to keep the lights on, electricity, those sort of things. Bit of all the more reason maybe to invest in some solar, to be honest, the way it's going at the moment. I know personally that's what I'm looking at the next couple of months. Gas prices, what are your thoughts on that? I know oil's come off. I think there was a solid increase over the past year. I think it was about 26%. That's going back to last year when it was very, very expensive through that period. Do you think much more could come off there in the coming 12 months in general?
Well, I think that will probably stabilise or even grow a little bit more, because I did notice that the OPEC's restricting their output, which will potentially impact price we pay at the Bowser, which will obviously ensure that there's a persistent growth there. And then on electricity, there's still more, unfortunately, there's more inflation to come there. I think the wholesale market in June is going to increase another 20%. So that number's not really going to go down anytime in the short term. We've really got to get that energy policy under sort of corrected.
Yeah, I agree. I know there's been a lot of news lately about AGL and them sort of starting to power down some of their older, I suppose, plants, I guess you could say, and then making that transition, that energy transition. So that's now going to start happening over the next 12 to 18 months. I think it means household energy prices will increase before they decrease, especially over the next 2 years. But I mean, it'll be interesting. I personally think we'll get a pause next month, especially just before the budget, and then June maybe one more. But given where I suppose inflation is right now, it's starting to curve downwards. We're getting the monthly readouts. It's all heading in the right direction. That's for sure.
That's right.
All right, guys, thanks for tuning in for today's episode. Look out for our next episode as we deep dive a little bit into HEX again, and inflation being where it is. There'll be some good little nuggets in there. Thanks for tuning in.
Thanks, James. Thanks, guys.